Hey everybody, I hope everyone's doing well and had a good day. This is going to be a brief recap of the Emini 5-minute chart for Friday, February 7th, 2025. I also want to apologize for the inconsistency this week. Just had other personal things going on, so thanks everybody for your patience. So I'm just going to do a recap. So instead of a bar by bar, just a brief recap of what happened today. So these blue lines here are the prior day's high and low. The reason I like to have those is because the prior day's high is often support or resistance. Prior day's low, the same, depending on where the market is relative to those prices. So if we break above the high of the prior day, you would expect it to become support. If we break below the low of the prior day, you would expect it to become resistance. So on the open today, there was a rally from bar 1 to bar 5, and it was a 5-bar bull micro channel. That's good for the bulls, but when we break down the price action and really think about what the market did, how the bars look, bar 1 is basically a trading range bar, small body, relatively big tails. Bar 2, an inside bar, again, small body, big tail. Bar 3, another trading range bar, closing at or below its midpoint. 4 is a decent bull bar, and then 5, another doji, so not great follow through. So the bulls really had one decent bar, bar 4, and it wasn't even closing on its high. And another thing I want to mention is that breakouts often fail at a higher rate on the open. And that's the reason you've heard Al or Brad talk about maybe waiting for the first 6 bars or so before trading in the open in the morning. And that's because of this. Breakouts often fail, and that means betting on the failure of the breakout has a higher probability of success. In other words, that's mean reversion, betting that the breakout fails and basically taking the opposite side of the trade. So one more thing to add with that, bar 1 was the low of the day up until bar 7. And, it doesn't take long to look back and see that, and you've heard Al talk about this, bar 1 remains the high or the low of the day only about 20% of the time. So it's about once a week. So it's not a common occurrence. It's really unlikely that bar 1 would remain the low of the day today. So the bulls hoping for a trend from the open. But then we got bar 6, and bar 6 was a surprisingly big bear bar. And it basically undid the entire rally up to bar 5. And again, if we think about the structure of the rally, we rally, pulled back, rally, pull back, rally, pause. That might be 3 pushes up. And you can call it a parabolic wedge, expectation, a minor reversal. But when you get bar 6, that's a surprise. And you can't count the legs. I want to back up and rephrase that. You can, if you watch the bar form, maybe it did sell off, pull back, sell off, pull back, sell off a third time. Or maybe it just slowly drifted down. But the point is, you can clearly count, or I should say more clearly count, the pushes up here. Even though it's a micro channel, you can count 1, pause, 2, pull back, 3, another pause. In here, it's just one bear bar closing on its low. So a stronger bear breakout, second leg down likely, and then big follow through on bar 7. So bear breakout and follow through, 6 and 7. You can call it reversal and follow through. Either way, it's basically the same thing. Every reversal is a breakout. And the expectation is sellers above on a pullback and second leg down. So bar 8, it's a good looking bull bar, but the context is bad. It's relatively small compared to the past, the sell-off to the left of it. And you can say this is a leg count reset for the bears. So leg 1 down, is bar 8 going to reverse 6 and 7? Probably not. So probably sellers above, and in this case, sellers on the close of bar 8. We did not get above bar 8. And the bears get a brief second leg down on bar 9. But is bar 9 really the second leg down? This is a really common structure, the formation of breakouts and second legs, where you get a big breakout, and this is basically a low one short, and you get a brief second leg, but it's much smaller than the first leg, and it's quick. It's a scalper's trade. A scalper maybe sells somewhere during the pullback, maybe the close of bar 8, but they take quick profits, expecting buyers below, because bar 8 disappoints the bears, or disappoints traders. What happened on bar 8? You have bears who sold the close of bar 7, or sold the low tick of 7, maybe even sold the low tick of bar 8, and those traders are then trapped on the reversal. Now the reversal is minor. Bar 8 is a minor reversal, but it's still disappointing enough that it's probably going to get a second leg. And that's what leads to buyers below. Disappointed traders, bears buying back shorts, bulls buying for a scalp. So we go below bar 8 on 9, we find buyers, and the bulls try to get their second leg. It looks like we didn't quite test the high close of bar 8. So the bulls really failing to do the absolute bare minimum. Well, that makes sense though, because we had a big bear breakout, leg 1 down, and if you're trading breakouts, it's easier to make money trading in the always in direction, and the big bear breakout is stronger than the minor reversal. So better to look for a second leg down than a second leg sideways to up. And that's why it's okay to hold through minor reversals. You can sell, use a wide stop, maybe above 6 or 7. You can hold through the minor reversal, and then bar, or I don't want to skip too far ahead. I wanted to talk about the structure of getting these quick second legs that are not really the second leg. It's that scalper's second leg, and then there's a more complex pullback. And then here we have 2 legs up, 1, pullback, 2. The bulls tried a third time. You can count 3 legs, truncated wedge, bear flag, and then everybody sold bar 17. And that is the real, or the symmetrical second leg down. I'm just curious. Probably some sort of measured move down. So if we use the high tick of bar 6 to the low of bar 9, we put that here. Actually, let me try to be more consistent. The high tick of this leg to the low tick of this leg to the high tick of the pullback, maybe here. And that gives you the leg 2 measured move to the tick. Or maybe just 1 cent above, or 1 tick above. So really accurate projection for the second leg there. And you can see that led to profit taking, so more minor reversal, big down, big up, but kind of similar over here. 18 is a minor reversal, but it's disappointing enough or strong enough that there's probably buyers below, second leg up likely. So you have the sell the close traders on the close of 17, disappointed with 18, buying back shorts on 19. You have bulls looking to scalp, buying below 18, but they're scalping out up here. That leads to more selling. And I joke around, we call this a zebra pattern. And it's no wonder why. It's just sideways, black and white, and it's tight trading range price action. Again, if you're trading, better to trade in the always in direction. Big sell-off, pause, big sell-off, pause, probably going at least a little bit lower, at least 1 tick below 17. And then here, sort of the fractal nature of price action demonstrated here. Bars 23 and 24. Again, you can call it a reversal and follow through. You can call it a spike. And then a pause on bar 25, and then a channel. So it's basically a spike and channel bear trend from 23 to about bar 31, 32. But it's also 3 legs down. You can count it different ways, maybe 9, 17, and 32. Or bar 79, 17, and 32. But you can see there's 3 pushes down, this might lead to 10 bars and 2 legs sideways to up, so it might be a better idea to exit shorts and okay to look to buy. But if you're buying, we still have not had a significant trendline break. So down here, if you're buying, you're probably looking for a minor reversal, not a major reversal into a bull trend. The bulls finally get a trendline break. I'll just move these out of the way now. When the bulls do break the trend line, they get bars completely above the moving average. That's good for the bulls. The problem up here, a couple of things. Market cycle. We have a breakout, deep pullback, second leg down, and it's a spike and channel. And the start of the channel often becomes the top of a trading range. So there's a sell zone from maybe here to, maybe here. This is a breakout point. You can also use these bars. But the point is, somewhere in this area between these lines, it's more of a sell zone. So as we get closer to this area, the expectation is resistance, unless the bulls can really just plow straight through it. Because in a bull trend, all resistance fails. But if it's a leg in a trading range, we can vacuum up to prices and then suddenly stop and lose momentum. So here, what leg is bar 44 or 46? It's at least leg 2. You might say leg 1, pullback, leg 2. Other traders might call it leg 3. Maybe 1, deep pullback, 2, 3. But it's leg 2 or 3 in a trading range in the sell zone at the top of a trading range. So more of a sell zone up here. So bull breakout, you can look for a second leg, but in this case, it was just a scalp. The bulls got their minimum, but this is interesting too. It's basically on a smaller time frame, it's a lower high major trend reversal. We have a bull trend, trend line break, retest, and then a major reversal. So 51, that's a more major breakout. It's still within the trading range, but this might be a leg count reset. So leg 1, better to just sell. If you're long, get out of longs. If you're flat, you can sell. Maybe look for a measured move down of the bar. And then pretty decent follow through for the bears. Not ideal because 52 is a lot smaller than 51. So you get a big bear bar and smaller bear bars. So we're getting follow through. But then down here, you can count 1, 2, 3, maybe even 4 legs down. So down here, you might expect a correction, maybe 10 bars and 2 legs. But this is a minor wedge. You can expect a minor reversal. Again, goes back to the market cycle. Spike, implied pullback 55 channel, probably resistance here. The market tested that resistance. The start of the channel became the top of a trading range. We found resistance, and the bears got a new low. But a 4-bar micro channel, maybe a 5-bar micro channel for the bulls, that's enough disappointment that there's probably buyers below, and the market's more likely in a trading range or a broad channel than a strong bear trend. And that's what leads to buyers below 61. And really just a tight trading range at the end of the day. Here, limit order market, maybe not worth trading. And I'll add in general, I'm not sure if it's worth trading past bar 70, 71, somewhere in this area, just because there's not a lot of time left in the day. And I've heard Ali say if you've had 70 chances, there's an opportunity on every bar, and if you've had 70 chances to make money throughout the day and you haven't been able to, maybe just leave the last 10 bars alone. I think that's good advice. So for stop orders today, maybe you can buy on the open. Again, for me, the first 6 or 7 bars, I'm not really looking to trade in the direction of the breakout. I'm expecting a reversal 80% of the time. So as far as buying up here, maybe not ideal, but I think 6 is a credible short. You can sell below 6. Through here, minor reversal, you can sell below bars, maybe the low 1, 12, low 2, 14 or 15, or even sell below 16. And then same through here, maybe it's a low 3 with bar 23. It's still always in short. Once we get down here, you know this is a channel on a smaller time frame. Lots of legs down, lots of implied pullbacks, and in the bigger picture, there's 3 pushes down. The wedge shape isn't great, but it is a late leg down here a couple of different ways, so you can expect a minor reversal, some kind of bounce. So down here you might look to buy, but not a great stop order setup down here. And then through here, maybe you buy above 43, maybe 45, high 1, but late leg, top of a trading range, really not ideal. Some traders might sell below 47, the neckline of the double top, get filled on 51. Otherwise, you can sell the close of 51, sell below 51, sell the close through here. After 3 or 4 legs down, traders probably exit above 61 if they're short. And you can buy above 61, but after this bear breakout, probably a minor reversal. So bulls take their scalp. You can sell on a stop below bar 65. And then the same problem down here on bar 70 at a new low, couple of legs down to bar 70, reversal bar. Might be better to buy above 70 than to stay short, and then limit order market through here. So that's going to be it for today. Thanks everybody for watching, and I hope everyone has a great weekend.